the crazy thing is that moving a 24/7 system, it's no longer a technology issue. It's now like a human workforce issue where we actually can't keep, we're actually the bottlenecks now. It's no longer the technology. It's no longer the money movement rails.
Hello, everyone, and welcome to The Future of Finance is Open. I'm Ian Horn, author of Why DeFi Matters, and I'm co-hosting this series with Aranjay Katakam, whose book corresponds with this podcast title. Today, we've got a great guest joining us in the form of Raj Parekh, head of stablecoins and payments at Monad, and co-host of the Money Code podcast. So, Aranjay, I'm going to start with you. Firstly, hi, good to see you again. And secondly, why have you brought Raj on for this episode?
Yeah, thanks, Ian. It's great to be back. And a good friend of mine and former colleague, Nika Nagavi, introduced me to Raj. Now, I have to say, Raj, this was one of the best introductions I had. And when I say best, I mean the way in which this introduction came to me, I have not had any other. And it wasn't just Nika, but everyone else I had subsequently spoken to in the last 3 months. Whenever your name has come up, just their demeanor changes. It's just that your kindness, which I have experienced myself, it seems to touch everyone. And the thing is that they say that nice guys finish last, but clearly that's not the case with you. So I don't know what your secret is. Maybe you'll share that with us today, but it's great to have you here.
Well, first off, I'm blown away by that intro, and I very much appreciate it. Did not expect that. But no, thank you for having me on. I don't know what the secret is. Maybe I'm still figuring it out myself, but it's good to be here, and I really appreciate the intro.
Brilliant. Thanks, guys. And thanks, Raj. Thanks for joining us. It's great to have you here. We're going to start, we've got several topics we want to go into. I mean, to start with, I want to go back to your days at Visa, because you launched a stablecoin settlement system to eliminate the risk of weekend settlement. And you did that back in the very early 2020s, if I'm not mistaken. Before stablecoins, traditional banking hours were creating massive stress for treasury teams, and they still do. At a macro level, the question I've got for you is, how is the transition to 24/7 borderless settlement fundamentally changing how global corporations operate?
Yeah, it's interesting because I think back before, the technology just really wasn't there. Like, you had to do batch settlement. You basically had to transact once a day. Um, but the crazy thing is that moving a 24/7 system, it's no longer a technology issue. It's now like a human workforce issue where we actually can't keep, we're actually the bottlenecks now. It's no longer the technology. It's no longer the money movement rails. And so changing and talking to a treasurer or a finance person or, a CFO and saying, hey, you can now settle 24/7, it actually changes the whole operation of your business, because you're so accustomed to the 8 to 5 banking hours. And then when you clock out, you're basically like, hey guys, I'm stuck. Like, I can't really move money anymore. And then you basically you go into work, you leave on Friday, you come back on Monday, you have a backlog of weekend transactions you have to complete. And Monday mornings are, if you talk to a treasurer, it's always the most stressful Monday morning, because you have this backlog that you really have to achieve. And so I think, fast forward to today, there's still like a mental model shift that I think a lot of organizations are still experiencing right now, where the technology is there, but their operations haven't really kept up with it. And there's many, many folks at the forefront now that are leveraging this, and they get to reap all the benefits of it. So we're still you know, early days, but humans are all like, honestly, the bottleneck here.
Yeah, that's so typical of these things, and I think that's been the case for a lot of blockchain, payments infrastructure for a long time. When you say people being the bottleneck, you kind of framed it as operational lags and institutions needing to get up to speed. But is there also a regulation and compliance challenge there as well? Because there's a lot going on, and for international payments to make sense, then a lot of people need to be aligned, right?
Yeah, funny enough, like a lot of the compliance, like AML requirements, anti-money laundering, like a lot of it is actually fairly consistent, whether it's leveraging stablecoins, blockchains, or your, traditional fiat or Swift rails. You have to know, the sender is the beneficiary, the purpose of the transaction, how much you're actually sending. Like, these attributes and what regulators and compliance folks require is actually exactly the same. And so I think that the practice of actually monitoring these transactions are slightly different. You have different tools associated with it. But for the most part, I think one thing that is pretty evident is that compliance people are getting very comfortable with the ability to move money on chain with its stablecoins. There's a lot of practices now as well. So I actually haven't seen a lot of changes in the compliance process per se. I think what I am seeing is people realizing that it's not different. It can be really cumbersome and ominous sometimes. Where you're like, wait, this we're now enabling a new payment rail. Like, what do we do here? And then when you actually really unpack it, you're like, wait, this is actually doesn't change my process. Maybe you have to add a few different lines to it. So I think that's what was really been holding us back from a compliance standpoint. But it's blockchains are still a very different beast. The crazy part about blockchains also is that everything's publicly available. You could audit the ledger anywhere in the world, and you could see that this transaction went through. Whereas with Swift, it's slightly different. You would have to, it's only you and the recipient that actually knows that transaction as well. So it actually gives regulators, compliance folks, a lot more visibility than your traditional payment rail today.
Yeah, absolutely. And I think that is where we're seeing this shift now, because I would argue that from 2025, this great convergence between TradFi, DeFi, and AI has started to take place. And we're seeing sort of this major narrative shift from crypto as a speculative asset to stablecoins as a utility, because stablecoins offer pseudo instant settlement. What I like is, I mean, you call this the internet speed, and then there's also the cost element that comes into play against some of the TradFi fees and things. And, so the question really here, Raj, is what happens to legacy correspondent banking networks over the next 5 to 10 years?
Well, there's a lot of pressure on them now, right? And even taking a step back and like how correspondent banking relationships work. I mean, typically like the JP Morgans, the Barclays, these larger organizations have like the largest correspondent banking networks. As you go down to the tier 2, tier 3 banks, it's much more difficult for them to build these like bilateral relationships across, different markets. And so they have to either piggyback off a JPM's correspondent banking, or they have to go bespoke and kind of build these relationships one by one, right? And so the process of even setting up a corresponding banking network is extremely difficult. Now, if you tell someone and a counterparty like, hey, I can just send you the money and I don't have to set up I could be in the US, London, Singapore, and I can send it all without a correspondent bank, that removes a lot of inefficiency from like the entire rail. And I think for me, like I'm always a big believer like markets are very efficient. And so if you just kind of think of that as like your mental model, like correspondent banking is going to be really tough to be in that business longer term because of the efficiencies gained with the new technology out there. I think one of the other benefits that correspondent banking may have, and that that could still take some time for the blockchain stablecoin world to kind of really take up, is FX, because you do have to build like local like liquidity from an FX standpoint, and you do have to build it out with stablecoins also. And liquidity is not something you can vibe code per se. You have to basically put the effort in. Every single day and month and quarter that goes by, liquidity starts to build up. And so I think until we see some, equal treatment of liquidity between correspondent banking, especially when it comes from an FX standpoint, to stable coins, correspondent banking is probably going to be in the past.
But one of the
Yeah.
things, Raj, here is that what we're seeing is that the incumbents are not standing still. JPM invests $18 billion a year in, and have driven so much, Onyx and Kinesis now. And then Swift have kind of announced at Sibos last year their initiative to bring the blockchain and somewhat of a unified ledger, as I understand it. So and other players as well. Like everyone is sort of looking at this space. And I feel like we're in this once in a century or once in a lifetime moment where this kind of shift is happening in financial services. So, the only thing I can kind of like an analogy is like when you had landlines and you have the shift to mobile. It's kind of like the closest for me. And even in that, BT, in the UK and AT&T and, others in other players in the world, they didn't actually disappear. They got bigger and stronger. They were the ones investing in the mobile technology, even though, Verizon and Vodafone came out of it. They were startups or didn't exist prior to that and have a decent market share. So I think my view is that we'd end up with this, you know, this is where the incumbents evolve and still retain some market share, and then you have new players that come onto the scene. And today those are in a stablecoin world issuers. The big issuers are obviously Tether and Circle, but even that is so early days. Like it's going to be interesting to see how that evolves. So yeah, I just wanted to see, what are your thoughts on how this exactly? Oh, in some ways we're speculating here, but how would it all play out?
Yeah, I mean, I think ultimately when it comes to, money movement and, liquidity, it really just comes down to distribution. And obviously the incumbents have that in spades today.
Yeah.
What the incumbents don't have is maybe the technical prowess and speed to actually go execute on this as well. So I do think there's an opportunity for like early stage companies to go and race and kind of build a best in class infrastructure and then start to scale distribution as fast as possible. While I joke that you can think of it as like speedboats versus like the cruise ship, like the incumbents being the cruise ships, they'll eventually get to that destination. Like they're now all kind of pointing their compass in that direction. They're moving. It's going to take some time, but if
Yeah.
you're early stage startup, you have the ability to be a speedboat and kind of race ahead. And so that I think that paradigm still exists. It's just a matter of like who gets there first. The JPMs, the Visas, the Stripes of the world. I think a lot of them. This is consensus in terms of we need to invest in this in some capacity, right? And if not, have a dedicated team and engineering effort around it. So there's no like I'm not having conversations anymore of like why stable coins or why blockchains. I now like go into the next level set of conversations of like, how is this like impacting my treasury operations? What does recon look like? What does compliance look like? Right. And so even from like the set of questions that are being asked, you can see that the incumbents are here and thinking about it deeply now too. So it's hard to speculate on who wins, who doesn't. I think it's really just going to come down to who's executing, who's focused, who's actually investing in the right areas, asking the right questions also. And at the same time, as an early stage startup, like that the game is very different now when the incumbents are thinking about it more deeply too.
Yeah, and this is really happening now as well. I mean, Aaron J mentioned Swift. Their blockchain ledger went live yesterday, as fate would have it. And it's July 10th today when we're recording. So it's all happening very quickly. Let's skip on to the next thing, though. Let's talk about stablecoin business models. Because you recently highlighted, Raj, that the US Genius Act is reshaping these. There's a move away from issuer-controlled interests towards user-centric models. How will this change the way that Web2 enterprises and PSPs monetize and adopt stablecoin infrastructure?
Yeah, I mean, it's interesting depending on the entity you talk to, right? If you're, and it also goes down to an existing business model. Like if I'm a bank today, like the lifeblood of my business is deposits.
Yeah.
And, I want to take those deposits, I want to lend on it many times over, from there, earn money on, on the interest. Um, Stable coins are not really interesting for me because I'm like, well, I can't really lend on stable coins. I'm really just, working with an issuer. I'm holding their reserves in treasury bills and they're earning, Fed funds rate at that point. And so it's not as exciting as a business model for me as a bank. Whereas, me as like now a fintech or an early stage company or a neobank, now you're saying, well, great, instead of me having to, use a banking as a service provider in maybe my, my the US market, hopefully negotiate some type of interest sharing so that I could share it back to my users so that I could earn deposits. I can now use a stablecoin, earn yield on it, directly from the treasury bills, directly from the reserves, just like built into the protocol itself. And now I can launch a business globally, which is kind of crazy. Like I can use, non-custodial wallets, I can use stable coins, I can earn, I can enable yield And now like what, took Revolut like maybe a decade to build, I can actually kind of turn on fairly fast.
Yeah.
And so the business model has been, has existed in terms of giving interest. I think it's how the interest is now given, and where it can be given has changed. And
Yeah.
that's now enabling, new products and new businesses that can scale globally and on a lot faster time horizon that we've never seen before. And so I think that's the part that I get, the most excited about. Otherwise, a lot of financial services, we're seeing the investing category continue to stay hold. You're seeing folks making money on trading volume. You have interchange economics with card spending, right? And so now, if you have a global product, you have a Visa or Mastercard, issued to it, you can earn economics on interchange as well. So a lot of the same business models that we've seen historically now work. They just work at a much more massive scale that we've ever seen before.
Yeah. I mean, does it look like we're moving away from the kind of interest-based business model though? Because obviously Coinbase have made significant, steps forward by offering yield to customers. Do we think the Fed is likely to shut that down, or is that kind of here to stay? I mean, I've been getting the impression that that's perhaps on the way out.
Potentially. I think with the Genius Act and with the Clarity Act coming up, there's likely going to be some implications, right? Is it considered a securities? Is it not a security? Do you have to be licensed in order to pass that yield on? I think Figure is a really interesting organization where they have an SEC regulated yield bearing stablecoin called yield, like YLDS yields. That is, they're following the law and almost kind of a step ahead in being able to generate that interest yield, right? So I think depending on the jurisdiction and markets, there are models that work in terms of giving interest sharing. But the model of we're just a stable coin, we can share interest for the sake of it. Maybe those days are over. But if you're regulated by the SEC and you're doing it correctly here in the U.S. With securities laws, maybe it's fine. At the end of the day, like what you see with like Robinhood or Revolut or Coinbase, yield and providing yield on deposits is a massive customer acquisition wedge, and it's a fantastic way of getting deposits. And so I don't see that going away as like a way to attract deposits. And then it's about what can you upsell that user afterwards to retain them longer term as well.
Yeah, no, I think that retention is really driving a lot of this. And I think one of the things to think about here, and I want to take you back to your Visa days, because it's interesting how, I mean, you were at the forefront of this, having founded that team. The card networks, such amazing networks, have kind of co-opted stable coins and embraced them. But that's one side of it for their settlement and weekend things and all of that. But what actually is the flip side of this is that the stable coins and the wallets have embraced cards. In the last couple of years, the number of wallet providers issuing cards to use whatever is in your wallet at a point of sale has been really fascinating. And so the question here really is around, if a simple card tap can eventually trigger complex multi-step on-chain operations instantly, does the concept of a traditional siloed checking account become obsolete?
Yeah, I mean, it's a really interesting question because today if I have a checkings account, maybe in the U.S. I have a dollar account, in London I may have a pound account. And as you go to other markets, your checkings account is typically denominated in your local currency, right? With stablecoins, you now can have a dollar account anywhere in the world. You can then spend that dollar as well. Um, Now that becomes a very competitive product to like your local bank in Argentina, Brazil, Mexico, Nigeria, where you're now not competing with like another bank for a Naira account. You're competing with another organization as a dollar account in your market. And so even from just a fundamental standpoint, the user is saying, well, I have access to a stronger asset that is like now my home base for wealth preservation. On top of that, I have the entire, hundreds of millions of merchants that support Visa and MasterCard today that I can spend with as well. Like that becomes a really interesting value prop. And it's actually very rational to come to that conclusion as a user as well. And I think that's been like the sticking point for a lot of the card networks. And something that we saw early on is that building out, hundreds of millions of merchants that have acceptance points to accept a card, extremely, extremely difficult to change. And you're not going to, disrupt that in a year or two. Like that takes decades and decades of work. I mean, yeah, and that's like the power of these networks is that when they hit escape velocity and they've compounded over decades, like Visa is almost a 75-year-old company now. Like that's a really, really difficult thing to solve in like a couple years. And so the moat that Visa and MasterCard have in terms of having that merchant network is very powerful. The checkings account, to what you called out, not so powerful anymore. And it's now you're now competing in your own market with a potentially stronger currency that now offers the same, if not better, like value prop. And so I think that's the thing that's like really shaking a lot of people and like having them reconsider what they're really doing with their users also.
Yeah, no, absolutely. And you have termed this as a dollar export mechanism, right? In emerging markets where there's this, you know, allure to holding, especially for freelancers and small businesses where they earn dollars instead of converting it into their local currencies, which is then putting pressure on their, on on the sovereign currency of their country. So this is really turbulent times in many ways as well. It's not just this sort of technology that is making things more efficient and, cheaper, faster, all of that, but it's also has a geopolitical angle to it, which, time will obviously show how that's going to play out. But yeah, would just love your thoughts on that as well.
Yeah, I mean, I think I think finance, fintech, the macroeconomics, like these things are all kind of connected together. The geopolitical components to it as well. It's all very deeply connected together, and this is why like it's very difficult to vibe code like regulated financial services. Like it's not something you can do, and so that's why even in this AI world where people often talk about software being really cheap to build, I get even more excited about regulated financial services as a core vertical because there's just, as the technology evolves, whether it's blockchain, stablecoins, maybe something else in the future, the regulation's still going to be there that you still have to go get licenses across those different markets as well. Um, and I think that's like the beauty of the 3D chess when you're an entrepreneur or a company in the financial services space is that you kind of have to consider all these different components to it. And, I even think about like, you would just even use an example like remittances. Remittances is actually, fairly trivial. Like you have, you're a migrant, um, moves to another country, sends money back to their family and friends. Maybe they send like $100 every couple of weeks, maybe send $1,000 a month, maybe to pay for bills and groceries. But for that country, that is receiving that money, that's like GDP impact. It's like if I'm a regulator or a politician, I actually want to encourage more remittances because it's now improving the GDP and like the local economy of my market. Now that medical hospital can now like get that bill paid. And maybe that grocery can now like get bought. Maybe that restaurant, maybe it's discretionary spending can be used it. And so the impact that you have of money movement and making it a lot more efficient can actually have like really massive GDP impacts for core markets. And so I think that's the exciting thing about financial services, is, to your point, is like there is a geopolitical component to it. It's very multifaceted, and the impacts and second and third order impacts of it is not immediately known because we use these products and services, and it can be fun using them, but sometimes we don't realize like what's actually the bigger picture too around it.
Yeah,
Totally.
absolutely. I'm going to move the conversation on to another major topic, which is agentic commerce. It seems to be all we're talking about in stable coins. I mean, I was at the StableCon event in Amsterdam a few months back. You may have been there as well, Raj. I'm fairly sure you were. And most of the sessions ended up discussing agentic commerce. It seemed to be the thing that everyone wanted to kind of be talking about. So that obviously brings its own identity challenges, non-human entities making high frequency financial decisions. That breaks down the kind of KYC framework. You're looking at more something like know your agent. So how does the industry's digital identity framework evolve to allow AI to transact without introducing huge systemic risk?
Yeah, I mean it's interesting because you have and there's no real like straightforward solution here because As you all know, like AI is in the midst of getting hyper regulated as well. Like we've already seen, bits and pieces of this already just happening across the US and other markets also. There's a real need to like localize some of the models that you're using. You can't use maybe like if you're in Europe, you may not want to use a US model because for various reasons as well. So there's multiple layers that I don't think we've fully unpacked yet. It's still very much early days. I think the straightforward path is that if an agent is transacting on my behalf, then ultimately I'm on the hook as the user, and so the KYC completed on me is probably sufficient in order for that agent to transact. Now, if the agent is autonomous or maybe doing things without a human supervision, which is you kind of get into the sci-fi world, that's where things get a little funky, and maybe some basic IP filtering or sort of firewall can potentially block that, and maybe that's sufficient as well. And so there's still like a lot of open questions here, but I think the basic of if I'm a user and an agent's transacting on my behalf, I should be KYC'd. And if there's a mistake, done by the agent, then I'm honestly on the hook for that as well. I think at the same time, like the way I see this is that agents are hyper rational economic actors. They're going to look for the path of least resistance. Now, if you're going to, and they're not reading headlines or they're not swayed by, like Robinhood's deposits or they're saying, cool, I've been given a task that needs to be executed. What is the fastest way for me to go do that? And oftentimes it might be, me trying to call an API for building a report or getting access to, building out a database or, paying for compute, which would be like a high frequency transaction, like you mentioned. I may look for the cheapest, most simplest way without API keys, without security that I can go through to make that transaction. And so I think turns a lot of people like, thinking about it differently, where if you have a hyper rational actor who's not looking at headlines or not swayed by ads anymore,
Yeah.
and they have to make these transactions with really low fees, then there is a question to be had whether it's stablecoins and blockchains or it's a card payment. And the truth is, right now, card payments have never been set up for sub dollar transactions. And going back to my Visa days, the only real company that we made an exception for these sub dollar transactions was Apple with the iTunes store back in the day.
Yeah.
As you can imagine, like what if like my kid accidentally bought an app or a song on the iTunes store and I was like, hey, Apple, like, I want to return that. That was an accident by my kid. Apple now has to go file a chargeback and a refund. It's cost prohibitive for that dollar transaction for any of these entities to even be dealing with it. Now, when you're thinking about transactions that are like micro pennies or micro cents that are happening at maybe at a fixed frequency, you can't like refund that transaction with cards. You can't ask like Visa saying, "Hey, can you like return that 2 cent transaction for me?" They're going to be like, "Dude, it's going to cost you 20 cents from a dispute standpoint for us to even process this through." And so you're kind of getting into like the depths of like the existing system right now when these transaction values are so tiny but happening so frequent that the existing companies haven't really solved for it or had to solve for it. Typically, a lot of these transactions are done where I might top up credits of like $20 with my card. I'm not dealing with it on a case by case basis on a high frequency basis. And so lots of room for us to grow and build. But what I do know is that the current construct isn't really set up for these types of transactions yet.
Yeah. And what sort of guardrails do you think are needed for consumers using agentic commerce as well? Because you get something slightly wrong and you've probably got a class action lawsuit on your hands.
Potentially, I think a lot of these are very standard like transaction controls, that you might set up. You might say, hey, I have a budget for $100, per week for my groceries. I might have, for discretionary spend at restaurants, maybe it's another $50, right? You can kind of set these limits with your agents, and the way you program into it is actually like quite robust as well. Now the question is like, do they bypass those limits? And then are you, that's where things get a little bit more sci-fi and tricky to really manage. But from what I've seen and what I've done with my own transactions, also these limits are fairly cool to do. I actually bought a card. I have a credit card that I use specifically for my agents, so it's not touching some of my other cards. And I've intentionally kept the credit limit for that card to be much smaller as well. So there's lots of ways that you can control it, whether it's at the whether it's programming it or just like structurally, just get a have a lower limit card.
Yeah, that sounds really simple and straightforward, and a million miles away from the whole. You're so right. I totally shouldn't have bought a Lamborghini today, which I hope we never go anywhere near. Thank you for that.
Yeah. And so, Raj, one of the things you've done is been sort of the early contributor to X402. That's the standard that Coinbase and Cloudflare introduced last year, I think it was. Can you, where do in this, based on what we've just been discussing with those microtransactions, how do you see that evolving? And just share some thoughts on that.
Yeah, so I as part of my work at the Monad Foundation, and Monad being an L1 EVM blockchain that's really geared towards high performance. I represent Monad Foundation as part of the X402 work over there. I think X402 has been a fairly novel protocol just to enable coordination between parties to accept transactions. 402 being a dormant field in the internet protocol world, which is kind of crazy. And you talk to organizations today, and sometimes they see millions and billions of dollars of 402 requests historically, but have never really been able to monetize it. And so I think X402 is an attempt to go see if we can build the right coordination and the right protocol to enable it, whether it's through card payments, through stable coins. I think it's a mixture of both. Um, the truth is, like, it's still very early right now, and so there's a lot of room and growth to really forge and learn from the market of like what does the market actually need in order for this field that we know like should have been in the internet back when the internet first started, but like now we're playing catch up. How can we make it all happen? So I think today it's still very much I think a year into it right now. The X402 framework is evolving. There's multiple different layers to it. There's routing, there's facilitators. There's a lot of folks building fun toy apps with it as well. Like one of my favorite ones is you can, instead of using an API request, you can send an X402 request with your address and a little bit of payment. And typically it can be done in stable coins and in less than a penny over a blockchain like Monad. And you send a request to this company, and I'm blanking on the name of it, but it'll send you a T-shirt automatically to that address, all via X402. And so like the time from like sending that transaction, sending that request over to like receiving whatever output you're looking for can happen like instantaneously, which is really, really cool. And it can happen anywhere in the world and globally. And so I think some of the core primitives and experiments with X402 have been really fun. And I think the way that I see these things is like, what developers are playing as toys on the weekends, like, famous Chris Dixon quote, these things typically, evolve into something more like robust and full-fledged in the future. And so it's just been fun being in like the early days of kind of forging this protocol into the future.
Yeah, it's really fascinating, and I was reading about it recently, and CoinDesk reported that there's $28,000 in daily real volume going through. That was in March, although much of that is the kind of testing rather than kind of real flows. But at the same time, it was interesting to see how they framed that. They kind of framed that as a lack of demand for agentic commerce, which, true as that may be, is perhaps a bit negative when you're dealing with something that is new, as you were saying. So I guess my question building from that is, what do you think needs to happen for that tipping point to occur for serious volumes to kind of flow through?
Yeah, I mean, I kind of see it as like a more of a supply and demand equation here. Is that right now is that you have the demand for using agents to transact is kind of amongst like a few like early cohorts of users that are like vibe coding nonstop. They're using all the latest models, and they're kind of playing and experimenting right now. And so the cohort of users is still growing right now. It still hasn't been fully adopted by my mom and dad, who are like now using their agents to transact yet. Whereas like in the traditional space, my mom and dad and my grandma all use credit cards today. So you've seen a full penetration of like a financial instrument that's now like to every single cohort in the world. And so I think the way I see it is like as any innovation cycle goes, like you start with the tastemakers, and then you cross the chasm and you kind of grow from there. So we're kind of at that moment right now where it's still early, and also because the user experience and the makeup of it still requires like some technical understanding right now. It it still isn't really built to and set up for the masses to now like adopt at scale. Now, with that being said, is that as we know with these innovation cycles that we've seen over and over again, is that these things will evolve, user experience will get better, the amount of supply and things you can buy with the agentic commerce and like the X402 protocol is only going to grow over time. And then once that demand side, starts to grow, the supply side ultimately grows with it as well. And so I think right now what you're seeing is like the a shift across enterprises and organizations, merchants saying, okay, there's like this new primitive right now. Let's just see how this continuously evolves. And it's the amount of like API endpoints where things are really kicking off at the technical level that are kind of slapping X402 on top and saying, hey, instead of like forcing an organization to a $20 a month like monthly fee, why don't we just say pay as you go? And by the way, here's like an X402 endpoint, and just like if you want to use it, just like pay us as you go. That's an interesting model because it decreases the barrier to entry for me to like subscribe monthly for whatever service you're doing. I really may only need it like once or twice, or maybe I need it like frequently over the next 12 months or so, but not enough to justify a monthly subscription for it. So there's like this middle ground of monetization opportunity that maybe most companies haven't been able to realize yet, that I think is still like available here. And so even some things that we're experimenting on the Monet side is that we've had to rate limit some of our, few public endpoints out there. And rate limiting meaning like, we basically throttle the amount of usage for it because we've basically made it available as a public good. But if we added an X402 on it with like some trivial amount of dollars, saying like maybe it's like microcents, maybe less than a penny, that itself could actually help mitigate, denial of service attacks or anyone abusing like our public services as well. So there's multiple dimensions here, and I think we're still very early, but the experiment across both the early stage and the enterprises is like definitely warrants the attention. I mean, as part of the X402 Foundation and my work on the Monad Foundation side, we have Visa, we have Adyen, we have Circle, we have Stripe, Cloudflare. Like these are all like very notable names that are dedicating resources and teams focused for it. And so it's worth watching as well.
Totally. Yeah, it's exciting times. And so, Raj, I want to bring us back to the start of the conversation when we were talking about, the treasury teams, because in a world, and just play this forward, 5, 7, 8 years, where, AI agents can negotiate routes, settle payments instantly, using these open networks and stablecoins. What role is left for traditional human operated treasury and compliance teams?
I think it's going to be managing. I think of it as like they're going to become managers of many agents that are conducting workflows and making sure agents don't mess up. And because agents have very clear rules and guidelines that it's operating under, but it may not have like the right context of saying, wait, there's a war actually breaking out in that country. We need to move our money out of that country as fast as possible because we're going to have idle funds that are now stuck because the banking system is not, letting things go. Like the agent may not have that context, but maybe a treasurer who's watching the news or paying attention to the news is going to say, okay, cool. Like we know we have to like take this action proactively.
Mm.
Um, and I think a treasurer might have 4 or 5 agents kind of working simultaneously on different actions on for efficiency as well. And they'll have to continue to fine tune what these agents are doing. And so I think of it as like agents, you can maybe attribute them to like a quant, at like a high frequency trading firm or, some type of analyst at an investment bank or something along those lines. You now have access to like quant level type of intelligence. We kind of direct them in the right direction at the same time as well. They have to know your business. They have to know like your processes. They have to know the pain points you're trying to solve for. And you also like, they are bound to mess up. Like there's going to be times where, agents are the most confident individuals and entities out there. They think they're right when like they're actually hallucinating as well. And so it isn't, I don't think the job is gone. I think the job has changed. And I think it kind of shifts into like an individual contributor to now like you're managing many agents at the same time too.
So essentially human in the loop.
Yeah, Yeah. At least for like sensitive financial, processes that way, because your CFO says what happened here. They're not going to go blame the agent. It's going to be the treasurer that gets, that gets scolded for like that mistake that takes place, right? And so, especially in sensitive workflows and organizations, at the end of the day, it's built by people, and people are going to be the ones that are held accountable as well.
Yeah, great stuff. Well, let's look at the battle for the financial operating system. On your podcast on the Money Code, which you mentioned earlier, you were talking about global payroll and why workers want dollar balances inside their apps, and yet compliant salaries still largely run through local fiat rails. So, with that in mind, I mean, how long will it take for the industry to bridge this gap so that the end-to-end stablecoin payroll becomes the global standard?
Yeah, I mean, it's an interesting question. I mean, there's multiple layers to it. And, if I'm and there's the incentives are different based on the entity in place, right? If I'm a freelancer, I'm always going to want the best currency available to me. And I may want to, I might be domiciled in Thailand or in Europe, but maybe I'm a US citizen for whatever reason, right? And for you, like you might want dollars regardless of where you are in the world. But if you're that country, you may not want it to be fully dollarized because you're like, hey, like we have our own currency that we have to maintain and hold. And so there's a lot of complexity when it comes to payroll and, these transactions where maybe, you can kind of give a pseudo experience where the user is going to get stablecoins at the end of the day, but how it got there is actually through a GBP FX conversion to stablecoins after, right? Which is something that, we've talked about the deal team is that you can't just, take dollars from that company and immediately send it to the stable coins. That actually is local regulation that you may have to go through the local currency before you make that conversion. And by the way, if you made that conversion, there might be a taxable event at the same time as well. And so it's no longer just like a technology thing. I think it's still like a very much a regulatory component to it. There's like a tax component to it. There's a compliance component to it as well. So there's, it's difficult to say like when things will evolve and change because these things, as you guys know, like regulation doesn't change that frequently, especially when it's in place. And so you still have to be bound to like the existing market structures as well.
Yeah, I mean, there's also the assumption baked in the gap will completely close. I mean, is there a case to saying that it doesn't ever completely close? Just it just shortens.
Yeah, potentially. And I think as technologies evolve, it puts more pressure on these countries and these regulators to saying, like, you guys got to give a better product. Like, if the product is, I mean, at the end of the day, like markets are efficient, people are going to gravitate towards the best product out there. And if I don't want to hold Argentinian pesos and I'd rather hold dollars, and you know, like that's the market structure of my geography, then as like a central bank and as a regulator, you kind of have to take that into consideration as well. And it puts a lot of pressure on them.
Totally. And there's this sort of tension the between all of these sort of players. Got it? So Raj, the thing is here, there is this tension between fintechs going borderless, the Wise of the world and others who saying beyond all these borders, there are no more borders. And then you have all these countries that are putting up, data localization and, are trying to kind of, even Europe, like sovereignty, digital euro and all this. So like there's this battle between the borderless world at internet speed and, the not incumbents, but, the governments and the regulators and all saying, hey, hang on a minute. I want to, I think of this as sort of a global race to regulate as well, so yeah, just would love your thoughts on how you see this play out.
Yeah, I mean it's tough because as a country, there's so many different things. It's a lot. There's a lot of complexity that's happening, and I think India is a really good example where the Indian rupee has recently devalued even more. I think it's hovering around like 95 to like $1 or something along those lines. And recently the government said like no more buying gold, or they're now like trying to impose more cuts and constraints around what you can do with the Indian rupee. And there's a macroeconomic component to it as well, where they're maybe trying to prevent the bleeding of like their currency. They're trying to maybe promote more economic activity between, their country, either domestically or internationally as well. And so there's like the incentive and goals of like the country itself, and then there's like the wisest of the world who are just like, we are, agnostic of countries. We're just trying to build a payment platform that makes it really efficient. And so I think that that tension will always exist because these things are always moving in different directions. And so, like in the India case, like right now, maybe it's really difficult to buy gold as an example, or maybe there's a prevention of buying gold, and gold is typically used as a wealth preservation tool. But maybe, as the Indian rupee recovers, maybe they start to loosen that requirement altogether as well. So I don't think of it as like a static, static piece. These things are constantly moving and evolving and changing as the rest of the globe changes. And I think the beauty of financial services and payments is that you kind of have to move with the flow and the rhythm of the economy. You can't just say like, hey, this is like the most efficient system in the world, use it. It's like you kind of have to flow with like where the water is going, versus pushing against it.
Yeah, no, I think I'd really like that actually, Raj. There's nuance to it all, and different countries are going to take slightly different approaches, and yeah, the tension it will probably always continue to exist. We are seeing, this witnessing this battleground on multiple fronts. So this we've just talked about a few, and we see sort of the battle to own the financial operating system of everyday life. So on the one side, we have legacy banks and closed networks. On the other side, open ledger, stable coins, tokenization. Fast forward to 2032, who wins the interface? Do everyday consumers and businesses interface with the economy through traditional banking apps, or would it be native digital wallets?
Yeah, it's a good question. And, I think the thing that I've been thinking about quite a bit is, I think of it as like community banking. And, community banking is not as prevalent in other parts of the world, but in the US, we have a ton of community banks. You go to your local city, they might have, you go to this random town and they'll have this random community bank that may have like two branches. Um, and, these community banks, they know your market super well. They know like the types of lending practices that are needed. Maybe it's like an agriculture town. So maybe this community bank really focuses on, giving loans to farmers as an example, right? um, the way I see digital wallets play out is like it's all becoming community banking at a digital internet scale, where it could be like a subreddit for Wall Street bets. And as you guys know, Wall Street bets community is crazy, but maybe a digital wallet for the Wall Street bets community where you can buy equities, crypto, and then you can kind of see a real time thread in like a news feed of like everything that's happening on Reddit for Wall Street bets. Like if I'm a hardcore Wall Street bets user or reader, that might be a really, really exciting digital wallet for me to use. Or on the other hand, if I'm a uh, if I'm like part of like a, very, if I'm a farmer in a specific town and I need, very specific services, like because I need to like, get a loan for equipment, or I need the right broker to help, take my supply and then, transact it with different counterparties. Maybe a digital wallet, maybe more specific for that, is actually way more useful than going to JP Morgan or Barclays in that example. And so I think as like the world gets, we're about the internet age is still growing and we're still only like, 30 years into it in earnest, right? Um, the digital wallets that start to build deeply for niches, actually will see, I think, a large amount of deposits. Surprisingly, the Wall Street bets community, sneakily enough, has potentially a lot of value over there. And so I'm really excited about some of these experiments where, actually, I'll give you another example. Another example, I was just a company I came across just this past week. Um, they are a faith-based financial service, and they actually work really closely with like the churches and in their local communities as well. And they're actually launching a digital wallet for their community, and they're going to have really safe practices around the types of products that they're going to provide as well. And there's going to be some elements, based on like their local community as well. So it's all early days and it's all experiments right now. But the fact is like it's so easy to build these financial services now. The tools are at your disposal, and we're going to see a lot of these communities that might seem small, but actually be really, really big businesses longer term too. They may not be like the JP Morgans of the world and like be this big giant, but they'll be large enough where I think will surprise a lot of people.
I love that, Raj. Community, it all comes back down to that. And I see this as the fintechization of everything, where essentially, you would end up just doing your banking with whichever community you're part of. And the whole the fact that you're banking is just abstracted away. You don't even have to think about that. That could be really powerful in many ways. I mean, Starbucks obviously have this huge deposit base based on people just buying their loyalty card, and that just can proliferate everywhere, right, to everything. And so it's just my last question here to leave you. We are meeting 3 years from today, Raj, and what would need to have happened in your view? Like, just give us a prediction on, you know, 2029. Where's the world of financial service? What's happened? What's the most interesting things you see?
Yeah, predictions are always hard. I feel like I'm always surprised and like impressed of how fast things move sometimes. And so maybe I think one is that we're only going to see more digital wallets. I think we're only going to see more. I wouldn't be surprised. Like, stable coins being at $1 trillion market cap would not be surprising to me. If we're at 300 billion right now, and you're asking me like in 3 years we can't 3x, um, seems pretty doable from my standpoint. I think we still need regulation, to kind of come in and be clear for like the market. I think the Clarity Act will be helpful in the U.S. and hopefully that can drive more adoption across other markets around the world as well. And so I think a combination of stable coins can continue to grow, and we should be talking less about billions, but more about trillions, because that's how massive these markets are. And so I'm trying to even change my mental model in thinking about things from a $1 trillion standpoint, because I think that's the opportunity in front of us.
Wow, fascinating stuff to finish on, Raj. Thank you for that. And I love some of the points you made there, especially around the way we look at wallets and community, as Aaron J was also enjoying, I think, as well. I think there's a real change in the way that we create and distribute products in financial services that could be on the way. I tackled this years ago when I was looking at cryptocurrency and thinking about, could you create a currency that fits a particular kind of informal currency, union's needs? I think it's the same thing, but on a different layer, which is really, really fascinating to me. Look, Aaron J, Raj, would either of you like to add anything before I wrap this one up?
First off, thanks for having me. This was a really fun conversation. It was fun to be here.
Yeah, thanks so much for joining us, Raj. I mean, for me, this is this great convergence that's happening. And, the question really is, are we going to use this opportunity to increase financial inclusion, health, and general welfare? Or are we just going to rearrange the deck chairs and the winners take all? So time will tell. It's not heading necessarily in the direction at the moment but that's why I love what you said about the community banking piece. Yeah. And I really feel like if we can take it in that direction, then we are actually doing something for the people whom it really matters.
Yeah, absolutely. Great point to finish on. Aaron J, thank you. Raj Parekh, thank you so much. You've been a wonderful guest. To everyone listening, this has been The Future of Finance is Open with Aaron J Katakam and Ian Horn. It's been a pleasure. We'll see you again for the next one.